Welcome back into Compounding Capital. In this video, we're going to talk about two mid-cap companies that have recently sold off and I believe could lend an opportunity. And one of them I'm going to break down with you personally. Now on this channel, we talk about fundamental analysis and long-term price action, which we're going to go over in this video specifically on two names here. The first stock we're going to talk about sitting right around a $7.5 billion market cap, which is that mid-cap territory of right around $2 billion to $10 billion in market capitalization. Recently sold off on earnings, and I'm going to tell you why I'm bullish on the stock. The second stock is Albemarle Corp. It's a lithium giant, and it's definitely been a volatile one, as most companies that rely on material prices definitely can be extremely volatile, but the future is very bright when we think about lithium. The demand is high, especially when we factor in adapting more to EVs. Now, OpenText offers many different things. Being a cloud-based platform, it has AI insight, e-signatures, collaboration opportunities, and recently they acquired a cybersecurity company to make sure that everything is protected within this cloud platform. The company IPO'd in 1998, has 24,000 employees, and with a cost savings plan, that workforce is going to shrink here as they cut 1,200 jobs. They're working on a $2 billion debt reduction, and recently OpenText acquired a cybersecurity company, MDR Platform. This Canadian-based company, stock price has been all over the place, as low as $27 a share and as high as $45 a share, and this company does pay a 3.3% dividend, the forward PE sitting right around 6 times earnings. It had a pretty harsh sell-off after earnings. Now with these mid-sized cap companies, a little bit of selling pressure can go a long way because the floats are not that high in these types of companies. And catalysts can move them pretty drastically when we compare them to your larger cap, safe haven type companies. And so this fall off to me, I think signals an opportunity. This is a company still in the growth phase, and margins were a question in this earnings report, which, as we see by the headline here, they are going to raise margin targets in 2025. So I do think margins are going to be just fine. When we look at what the company is doing, it's kind of everything you can ask. Decent valuation, still growing at a high clip, announcing a $300 million share buyback, and increased the dividend by 5%. So as I start looking at this company, there's a lot of things I'm really liking. They're guiding for better margins in the future. They're growing at a pretty substantial rate. While that growth is slowing down, I still think they're going to grow pretty strong here. I have them growing, low single digits just for analysis purposes, but I think they can absolutely crush that. They're buying back stock, they raise their dividend, and they have pretty strong free cash flow and really nice margins. So while the year-over-year numbers are extremely strong, the reason why the stock sold off is going to be the quarter numbers. Total revenues came down 8.6%, reflecting an AMC divestiture completed May 1st, 2024. The annual reoccurring revenue for the quarter was down 5.5% year over year. Cloud revenue still remained at 2.9% growth, and quarterly bookings were up 10%. When we looked at it from a year over year perspective, very strong numbers, but adjusted GAAP EPS was sitting at 445 million. So there is still strong margins within this business, even though margins were an issue for the quarter. When we look at earnings from a GAAP basis, they earned 91 cents. So when I look at cloud companies, this one is very interesting. Yes, it doesn't have the astronomical revenues that we see a lot of the big cloud players have, but cloud is going to be adapted. And as I said before, there's going to be spillover effects, and some of these smaller companies are going to gain some serious market share. And this is one that has a lot to offer to customers. Now, this is a company earning 90 cents a share. So we multiply that by 4. We're looking at nearly $3.60. We'll even go on the low side and say $3.50 of earnings. Stock's been trading between 28 and 28.50. We divide that by the 3.5. We get about a forward PE sitting around 8 times earnings, which is pretty cheap here. And this is why I don't go off of earnings when I'm looking on certain websites, when they just put the forward earnings out there. I kind of build the story that we're seeing quarter over quarter some problems here. Now, if this persists, we obviously have to go back to the drawing board. But I'm still giving myself some leeway here and saying that they're not going to earn 91 cents. They're not going to earn $1. They're going to earn just 90 cents a share. And if they do that for consistently for year 2025, we're looking at paying 8 times earnings for a company that's doing a $300 million buyback, is in the cloud space, has a 3.3% dividend that was just raised by 5%. And now we're going to take a look at the balance sheet. So cash and cash equivalents are sitting at $1.2 billion, and total debt sitting at $6.6 billion. We can see that total debt has come down substantially from 9.2 down to 6.6. There's a lot of things I'm really liking about this company here. As of right now, I really have to put a buy on this company, sitting at $24, $25 from a free cash flow perspective, and sitting a little over $28 from a multiple to EBITDA. It's in the wheelhouse right here. I think anywhere between $24 to $28, you can definitely be looking at this stock. You're getting a nice dividend. You're getting some possible strong growth tailwinds ahead, and the management is doing everything right, knocking down that debt, buying back stock, and they're positioned extremely well to have substantial growth in the future. So I wanted to bring this one to your attention. It's probably not a stock that gets talked about a lot. I actually stumbled on this one, and I really like everything that they're doing, and I like how they're positioned, which is now going to lead us to the lithium giant Albemarle. Lot of headwinds with this company. We've watched lithium prices collapse, and we've seen Albemarle halt expansions. And with lithium prices really being a headwind for the company, we're actually seeing them making cuts and not expanding. Very volatile stock at a 52-week range, sitting at $82 and $205. So it's been in a pretty substantial downtrend, and at this point in time, I'm not seeing any sort of catalyst that's kind of push it out of this downtrend, but we should be finding a bottom, I'm imagining, here pretty soon. This is a company that had tremendous growth in 2022 and 2023, and now coming back to more possibly a normalized level. When we look at sentiment around the stock, we have a high of $280 and a low of $81, so we can see here that it is a wide range, and you're going to see that normally with any sort of materials type stocks. Now, stock analysis has them taking a hit in 2024, but then re-accelerating growth 2025 and beyond, where we're going to see earnings per share follow that number. So this is a really hard one to figure out, and what I'm going to do right now is use low single digit growth rates once again. I'm going to try to put it in that, I'm going to try to put the revenue for 2025 in that $6.4 billion range. I'm building safety multiple ways. I'm not using astronomical growth rates, and I'm actually coming in under what 2025 expectations are. And this is a good dividend history, 29 years of consecutive growth, while 29 years of consecutive payouts. When we look at cash and cash equivalents, we're sitting at $889 million, total debt sitting at 4.28. When we look at historical EBITDA margins, they're definitely heading in the wrong direction, but this is a company that should be doing high 20% EBITDA margins. So as I said, I'm definitely building some safety in here. Particular symbol ALB, Albemarle. The lithium giant here, it's going to be extremely volatile, but I think around that $70 to $85 range is where this stock definitely gets interesting. It really depends on how bullish you are of the future, because what I'm kind of doing here is I'm really undershooting what their revenue is going to be. A lot of analysts think that they're going to be doing close to $8 billion by 2025. So even if we just plug in that $8 billion, we get 8.1 by 2025, 8.6 by 2026. If you think this is more realistic of what the company's capable of doing, and you think margins can get back under control, then I definitely think it's a buy right now. But if not, I would probably try to get it back near that 52 range mark of 82.25. And the odd thing is that's about where I think it makes sense to start buying the stock. A break below that into the high 70s, obviously I think that's where it gets really interesting. But the analysis really lines up with the recent 52-week low for me personally. Now, of course, these are numbers that I'm personally plugging in my thesis that I'm building here. You have to do your own due diligence, guys. This is not a recommendation to buy or sell stocks. This is just me showing you guys the process here. As always, really appreciate your time. Hopefully you all enjoyed, and we will see you in the next one.